The S&P 500 represents a concentrated core of global economic production, serving as a primary vehicle for long-term wealth. It tracks the 500 largest companies in the United States, from Apple and Amazon to NVIDIA, and has functioned as the primary benchmark for the American economy since the mid-50s. Performance data since 1957 shows a consistent upward trajectory, averaging 10% annual returns. This reliability makes it a stable worldwide. However, for Canadian investors, accessing this growth introduces cross-border friction that can quietly erode your total return. Failing to navigate the specific tax and currency rules between our two countries can turn a high-performance portfolio into a leaky bucket, where avoidable costs bleed away your true profit potential. The primary source of this friction is a 15% U.S. withholding tax applied to dividends paid to foreign investors. Many Canadians inadvertently trigger this tax by holding U.S. assets in a tax-free savings account. While the TFSA is a powerful tool at home, the tax-free status is not recognized by the U.S. government. The deduction happens automatically at the source. Before a dividend payment even crosses the border into your TFSA, the IRS claims its 15% share, leaving you with only 85% of the original payout. Because the IRS does not see the TFSA as a retirement account, these dividends are taxed before they ever reach you, resulting in a silent annual drain on your compound growth. Solving this requires choosing the right investment structure. The most accessible method is buying Canadian-listed ETFs like VFE or ZSP, which trade in Canadian dollars on the Toronto Stock Exchange. These funds are convenient, but they don't solve the tax problem. Because the fund itself is a Canadian entity, the U.S. dividends are still taxed at the 15% rate before the fund distributes them to you. To eliminate that tax drag entirely, investors rely on the Canada-U.S. Tax Treaty, which provides a specific exemption for retirement savings. Under this treaty, the U.S. government recognizes the Registered Retirement Savings Plan, or RRSP, as a tax-exempt account. Securing that exemption requires a specific pairing. You must hold a U.S.-listed ETF, such as Vanguard's VOO, inside an RRSP. In this specific configuration, the withholding tax drops to zero. This also lowers your internal costs. Direct U.S.-listed funds often feature lower management fees, with some charging as little as 0.03% annually. For long-term retirement, matching an RRSP with a U.S.-listed fund is the most efficient way to capture the full power of the S&P 500. The challenge with this optimized strategy is currency. To buy a U.S.-listed ETF, you must first convert your Canadian dollars. Most brokerages charge a currency spread of nearly 2%. On a significant investment, that one-time fee can be higher than the taxes you're trying to save. To bypass those high spreads, many use a technique called Norbert's Gambit, which involves journaling an interlisted stock across exchanges to convert funds at a fraction of the cost. For investors using taxable, non-registered accounts, an alternative like the HXS ETF uses a swap structure to avoid dividends entirely, deferring all tax obligations until you decide to sell. Achieving full optimization is a balance. You must decide if you prefer the simplicity of a Canadian fund or the higher efficiency of the RRSP and currency route. Moving from theory to execution requires a few concrete steps. First, select a low-fee Canadian brokerage. Second, open the account type that matches your strategy, likely a TFSA for simplicity or an RRSP for tax optimization. Third, fund your account. Once your capital is ready, search for your chosen ticker symbol, like VFV or VOO, and place your order. If you've chosen the RRSP route, ensure your brokerage has a W-8 BEN form on file. Most do this automatically, but confirming it ensures the IRS recognizes your tax-exempt status. Automating your contributions through dollar-cost averaging helps neutralize the impulse to time the market. By investing a fixed amount regularly, you buy more shares when prices are low, which helps smooth out your average cost over time. Remember that the S&P 500 is a long-term commitment. A horizon of at least 5 years is necessary to move past the noise of short-term market fluctuations. Success depends less on waiting for the perfect moment and more on getting started. Choose your structure and start putting your capital to work. Long-term results are driven by consistent contributions and an efficient tax structure. This content is for educational purposes only and is not financial advice. Consult with a licensed professional before making investment decisions.